Welcome to This Is Money podcast. I'm Georgie Frost, and joining me and editor Simon Lambert today is assistant editor Helen Crane. And coming up, the mortgage market mayhem continues. With home loans hitting their highest prices since 2008, we look at whether to fix for 2, 5 or even 10 years, what you can do if you can't pay, and ask, will mortgages hit 10%? Also today, on the flip side, good news in the savings market as top rates edge closer to 5%. Moving the top level of tax for the rich went down like a lead balloon, but our Simon's been looking at some middle-class tax cuts that could prove to be a winner. And selling letters from a world-famous rock star. Do you have to pay tax on that? Don't forget, you can stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Market updates and conversations around the financial world don't have to be boring. The Digest and Invest podcast by eToro is a great way to tune into what's happening in a fun and easily digestible format. Discover the Digest and Invest podcast at etoro.com/academy/podcasts.
But first, mortgage rates continue to make headlines as the fallout continues from the Chancellor's tax-cutting mini-budget a fortnight ago. The average 2-year fixed mortgage rate has reached over 6%. That's the highest level of interest in 14 years. 5-year fixes aren't far behind. But how high will they go? 10%? More? The question is, if you're a homeowner needing to remortgage or you're looking for a loan to buy a property at the moment, what do you do? Fix now if you can, but how long? Pay an early repayment charge, perhaps roll onto a standard variable rate mortgage and hope the storm will pass soon. What to do? But first, before we get into that, Simon Lambert, what is going on in the mortgage market? Is the dust starting to settle from when the proverbial really hit the fan last week?
What is going on in the mortgage market? What an excellent question, Georgie. What is going on in the mortgage market? We have seen the unexpected arrive in that although interest rates have been going up this year, Bank of England has been busy raising interest rates to try and combat inflation. We've gone from 0.1% base rate in December last year to 2.25% now. The pace of those interest rate rises is not slowing. In fact, potentially it's accelerating. But we've seen a dramatic escalation in how that's fed through to mortgage costs over the past month. Regular listeners, anybody who hasn't been living under a very large rock over the last month will not really need to be told about the fiasco that was the Chancellor's mini budget. But the reaction to that and the plan for Britain that involves an awful lot more borrowing and therefore an awful lot more government debt that needs to go to the market, and the market has decided that in order to buy that government debt, it would like to be rewarded with higher interest rates on it, has fed through to the mortgage market and led to a dramatic repricing of loans. So we are in the scenario now where the average 2-year fixed rate mortgage and the average 5-year fixed rate mortgage as well now is coming in at higher than 6%. We haven't seen rates like that since 2008, since financial crisis times, before rates were slashed to the bone by the Bank of England to deal with that. I think we are at a point where we are seeing real stress in the mortgage market. The vast majority of people are protected from this because the vast majority of mortgages are taken out on fixed rates. But anybody who is coming to the end of a fixed rate is facing remortgaging onto a much, much higher rate than they expected and the one that they are on.
How much are we talking cash terms here, extra a month, ballpark?
Okay. We're talking hundreds of pounds. I mean, for the average mortgage size, you're probably talking £300 a month, roughly. I mean, for the average new mortgage size, for somebody who was buying a property, you're definitely talking that kind of sum. I mean, it swings around because obviously house prices vary wildly around the country. So people taking out mortgages to buy a flat in Leeds, for example, are taking out much smaller mortgages than they would be to buy a flat in London or St Albans or Reading or anywhere like that. But what we're seeing is a big jump. And actually, to put it in perspective, I checked mine and I have got 3 years of a 5-year fix left to run, luckily, because if I had to remortgage today, I would be looking at an extra £700 a month.
Wow.
Yeah, that's a lot of money. I don't have £700
But
to spare.
nothing extra.
Knocking
This is
around.
what's
Nothing extra.
ridiculous.
Yeah.
You're not getting any
No,
benefit, anything extra. You're just banking £700 extra a month, or you would be.
Exactly. It's what I refer to as the car tax problem, whereby car tax is annoyingly expensive and you see no benefit for it. Your car doesn't go faster, it doesn't drive better, it doesn't do anything better.
The roads aren't that much better, the potholes are still there.
Exactly. You remortgage, your mortgage doesn't do anything better, really. I mean, you might, maybe get one that's better suited to you or something, but it's not really going to dramatically improve it. Your house isn't going to get any better. You're just paying more money for the same thing. And as this feeds through, this is definitely going to be causing people quite severe financial headaches. And I have spoken to a number of people who are in the unfortunate position of having to remortgage now or in the next 3 to 6 months, and they're staring down the barrel of having to find hundreds of pounds more. The question is it just a moment in time? And is it going to ease? So actually, we did see HSBC cut some mortgage rates this week, but we are still, as I said, we're still seeing the average go up, and the average 6% on a 2-year, 6% on a 5-year is very high compared to where it was. And, to put things in perspective, we're talking about a scenario where a year ago, people were managing to fix under 1% in some instances, and those same people would now be looking at 5%. And that's a very dramatic shift in the landscape for people owning homes and buying homes. Only affects about a third of households, because only about a third of households are mortgaged home buyers. There's another third that just own their home outright, don't have a mortgage, so they're okay, and they're getting better rates on their savings, which is good news for them, which we'll talk about later. And then there's another third who are renters. Now, renters are who will be affected. They aren't protected from this. They're protected from this in the short term. They don't have to remortgage anytime soon, but they're not protected from it in the sense that this also impacts buy-to-let landlords. And when buy-to-let landlords suddenly see their costs go up, they ultimately will try to pass them on to their tenants. Or you might see many of them sell up. I mean, it may be if many of them sell up, and I'm sure we'll talk about house prices in a bit, then maybe that ultimately benefits any of those renters who do want to buy a home. But that's going to take a while to filter through. And I think that this is going to feed through to higher rents as well.
Helen, what does this all mean for first-time buyers? I was thinking of buying myself, speaking to a mortgage broker even, not a couple of weeks ago. No, I'll let that one go.
Yeah, that's possibly wise, I think, just to leave it for a while and see how things go. Obviously, first-time buyers tend to have the lowest deposits, so they're taking out the biggest mortgages, and that means they're kind of always at the sharp end. When rates go up, they're probably going to be charged the highest rates on the market. It could put people off buying. I've got friends who are looking to buy their first home soon, and they're saying, shall I wait for a while and see what happens? Because it's so uncertain at the minute.
Should you? How long should I wait? How long should your friends wait?
Well, that's the thing. It's really difficult to say. No one has a crystal ball. The suggestion from some brokers at the minute is that in a couple of years' time, maybe...
A couple of years?
Well, could kind of go back to the sort of level of normality that they were, say, 6 months ago, when they were kind of around like 2%. We just don't know. I mean, the last 2 weeks have shown anything. It's that, mortgage rates are very kind of vulnerable to fluctuations depending on what's happening in the kind of wider economy. It's really difficult to say. The other issue is we haven't seen this necessarily yet, but the last time there was big financial uncertainty during the COVID pandemic, a lot of lenders pulled their first-time buyer mortgages. You would see them take kind of 95% LTV mortgages completely off the market. And then when they came back, they were really, really expensive. We haven't seen that yet, but it's something that, could feasibly kind of happen again if this continues. If lenders are feeling a bit nervous, they tend to pull back from lending big mortgages to people. So it's a worrying time. If anyone is a first-time buyer kind of in the middle of a purchase or about to sort of take out their first mortgage, what I would suggest is definitely talk to a broker, because they will have the latest information on what rates are available, and they'll be able to give them some advice on whether they should maybe wait, what the rates they could potentially get are, and just kind of, give them that sort of expert advice on where they should go with it all.
The problem is, in terms of waiting, it means renting for longer. Rents are really high, so you're not going to be able to save any more for a deposit. If you're looking for a rental, it's an absolute mayhem out there. Look, Simon Lambert, according to Halifax, though, house prices dipped in September by 0.1%. A sign perhaps of things to come. Rates may be going up, but prices may be coming down.
I mean, you'd be a fool to try to call common sense in the property market, having seen what we've seen over the past decades, and particularly the last couple of years, the mad pandemic property boom. But common sense would tell you that on the basis most people have to use a mortgage to buy a home, if the cost of said mortgage has gone up dramatically, therefore limiting the amount that they can borrow. So they may have previously been able to, say, for example, borrow £200,000, but with these new higher rates, they might now only be able to borrow £175,000, because mortgages are done on an affordability basis. And if your repayments are going up, then they take a bigger chunk of your monthly income against how the measure is done, and so on. Well, common sense would tell you that house prices have to come down. I mean, I don't really see a scenario where this doesn't have a negative impact on house prices, but you never know. I mean, there are some saying the market can ride this out. I mean, it's done weirder things before, but I do think that we're going to see some stress in the property market off the back of this. I mean, the last time this happened, I remember the last time this happened, the financial crisis, when the credit crunch and so on, and that did have a severe negative impact on house prices. They did eventually start going back up again, and actually the effect was limited by the fact that the Bank of England slashed interest rates down to the emergency 0.5%. So we went from like 5% to 0.5% base rate. The problem is this time round, that option isn't there. The reason why this is happening is because the Bank of England is having to raise interest rates to combat inflation. I mean, it can't suddenly reverse that and start hacking interest rates back down to the bone. So what do? We saw pictures yesterday of the bosses of the big banks heading in for a chat with the Chancellor. I imagine they're sitting around the table and saying, well, what do we do here? How do we work this one out? And I don't think there is an easy answer. How soon house prices come off the boil, if they do, is another question, though, because I mean, house price inflation is easing, but it's still at 10%. House prices are still 10% higher than they were a year ago, roughly 20% higher than they were at the start of the pandemic. But what that tells you is that house prices could actually fall by a fairly large amount, and they'd still only end up where they were at the start of the pandemic. And actually, at the start of the pandemic, house prices were pretty high. I mean, there's the chart that we keep publishing time and time again of house prices versus wages. They are now more expensive compared to wages than they have ever been. But at the start of the pandemic, before we had this crazy boom, they were nearly as expensive as they'd ever been. So we'd only end up back at that level. I mean, to get to fair value, well, that would be a huge fall. And I don't think that, that would be catastrophic for the economy. So I think you'd definitely see someone step in before that happened. But it is a real conundrum and a real puzzle as to what's going to happen. We've got Ed Magnus looking into this for us, speaking to some people. And he told me yesterday that he's got someone who says actually they don't think it's going to knock the market at all. And they're sticking by their predictions, another couple of years of gains. But that does seem a little optimistic to me.
Goodness me. Let's get some practical advice, though, Helen. A lot of people will be asking, what on earth do I do now? If I'm coming off a fix, or actually if you're not, do you pay an early repayment charge? If you are coming on off fix, do you fix for 2, 5, 10 years even? Ooh, that seems a lot.
Yeah, so again, it's it is a real guessing game at the moment. I don't envy people who are coming up to a remortgage deadline. You know, do they fix for 2 years, 5 years, even, you know, 10-year mortgages are out there. There's been, you know, a lot more of them coming out in the last couple of years because rates have been very low. I mean, somebody who fixed a 10-year deal, say a year and a half ago at 1%, I mean, they're absolutely laughing now. But it is, you know, taking such a long fix is a really big gamble, especially, you know, if you're not in your forever home, you might need to move. That can be quite a risky thing to do. Looking at 2 and 5 year rates, so it's interesting. 2-year fixes are now more expensive than 5-year fixes, which hasn't been the case for several years. You know, 2-year fixes were sort of very popular, and you know, people thought even 5 years, oh, that's a bit long, which you know, I think is a bit of a mistake, because you know, those mortgage deadlines do kind of go by quite quickly. And obviously you're if you're paying fees on your mortgage, paying, you know, £1,000 every 2 years rather than every 5 years, it all adds up. But looking at the minute, we've been speaking to some brokers. This is our mortgage reporter Fran. They've all got sort of different opinions, but there does seem to be a bit of a consensus that 5 years might be the way to go at the minute. So they look at swap rates, which is basically the rate at which banks swap the interest payments on mortgages with each other. It's a bit complicated, but essentially swap rates kind of show where the mortgage market thinks rates are going. And at the minute, they seem to show that rates are going to rise for about the next 2 years and then fall back after that. But we don't actually know. It's a long time away. It's a big gamble to take. So brokers are generally saying, if you can't afford to essentially take a bit of a gamble with your mortgage, you should probably fix for 5 years. I think by that time, rates will definitely be cheaper than they are now. So that seems like the general advice. But yeah, you know, a 2-year fix, it could potentially pay off. But yeah, we just don't really know. Another option, as you said, some people are even considering looking at, you know, potentially going onto a variable rate temporarily, or even taking a tracker. I mean, that hasn't made sense for some time with rates being so low. But if you're looking at now, some of the average rates around 6%, you know, some banks' standard variable rates are around that. I mean, if you are coming to a remortgage deadline and you know, you want to wait it out for a bit, it might not necessarily be the worst idea to go
a friend of mine
to a variable rate.
Worked out they'd be paying £900 extra to fix a month, and they were like, wait.
Yeah, and I mean, the thing is that variable rates don't tend to have any early repayment charges. So, you know, you might be paying a little bit more in the short term, but you can exit that mortgage without any fees. It might be an option just to kind of hedge your bets for a little while and see where things go. Again, do talk to a broker if you're in this situation, because they'll have the most up-to-date information and be able to give you a bit of advice. I mean, good advice is kind of difficult to come by the minute because things change so fast. But yeah, they're the best placed people to try and help.
Precisely, they're the experts. Simon,
one of the issues with the variable rate mortgages is that the cheapest ones as well are discount rates, and people need to be aware of the difference between a discount rate mortgage and a tracker rate mortgage. So a tracker mortgage will almost always follow the Bank of England base rate by a certain amount, and so it will only move if the Bank of England moves the base rate. A discount rate variable rate will follow a lender's standard variable rate, and it will move in line with the lender's standard variable rate, but the lender can move the standard variable rate any time that it wants, and it could move it by more or less than the Bank of England base rate, or not move it at all. So you are a bit at the mercy of what the bank or building society decides to do. Now, under normal circumstances, I would always have said to people, don't take a discount rate, don't take something linked to the standard variable rate, because the lender could do anything. Take the tracker rate, because then you know that it'll only go up or down by as much as the Bank of England base rate. And actually, lenders don't tend to move their standard variable rates when the Bank of England isn't moving the base rate, but they have done it in the past. Okay. So, and there was a bit of a furore about this, I don't know, like 5 years ago. It's probably longer than 5 years ago, actually. Yet, there's something funny going on with standard variable rates, in that standard variable rates haven't moved up by as much as the Bank of England base rate, which is a weird scenario, because normally lenders like to lump a little bit of extra on top. So they quite often go up by more than the base rate. You know, you find that borrowers get the base rate rise, savers don't get the base rate rise. That's the old rule. But quite a lot of standard variable rates were already quite high compared to where the base rate was. They hadn't been dragged down when the base rate was hacked all the way back down to 0.1%. So weirdly, we've seen a scenario where banks and building societies have soaked up a bit of those Bank of England rate rises rather than moving up the standard variable rates in line with them, because those standard variable rates were already relatively high. So you might potentially be in a safer position now taking a discount rate linked to the standard variable rate than you would be with the tracker rate, because it might be that standard variable rate doesn't go up by as much as the Bank of England base rate. But that is another level of gamble that you are taking, whilst also taking the gamble of a variable rate mortgage rather than a fixed rate mortgage. So the thing I'd be doing is I'd be looking at the lender's standard variable rate, how that compares to the wider market, and what their history of moving that rate around is. Have they just been passing on the base rate? Okay, so then you're like, okay, well, this is probably just going to move base rate. Or have they actually been soaking some of it up? And you think, okay, well, maybe they might continue to do that. Is it relatively high compared to other standard variable rates? Because if it's relatively high compared to other standard variable rates, then it's quite likely they might soak some of that up. But check, have they been soaking it up, or have they just been passing it on? That's why it's so high. So you need to think about some of these things as well. And the only other thing I'd say with the variable rate stuff is it is a gamble. You could argue that the Bank of England is not going to get interest rates anywhere near as high as the market thinks it's going to get interest rates, because the financial stress that's going to be triggered by this. And also you need to think about what the Fed's doing over in the US, whether the Fed's going to get rates anywhere near as high as people think the Fed's going to get rates, or whether it's going to have to stage a U-turn because of the financial stress being caused. And then you might be willing to take that gamble on the variable rate mortgage, be it the discount rate that I've talked about with the extra gamble, or the Bank of England base rate tracker mortgage. You can jump ship for free, but you might find that you're jumping ship onto fixed rates that are even higher than they are now. So you need to take all these things into account. So I would say that this is a move only for people who are willing to acknowledge that they are taking a bit of a gamble. And with some of the money that they are saving from that, they put that aside to build themselves up a little bit of a war chest, that if things do go Pete Tong and it all moves in the opposite direction to what they're hoping happens, they've got some money set aside with which to then soak up the extra costs that they're gonna have. So it's not a move for everyone.
Some good advice there, Simon. Finally, Helen, with rising rates, you have an article on your website which explains what you can do if you are struggling to afford your mortgage at the moment. There's a few options here. Again, bear in mind it's not for everybody, but can you just outline briefly what they might be?
Sure. So obviously the first thing to say is, your mortgage should be your kind of priority bill. If you are at all able to keep your mortgage as it is and keep paying it, that is almost always the best thing to do. But clearly the cost of living crisis is affecting them in different ways, and some people will sort of really be struggling. One of the most sensible things to do is potentially to extend your mortgage term. So that would mean you might go from sort of 20-year term, say 25 years. You're giving yourself an extra 5 years to pay that money back, which means you can spread the repayments over a longer amount of time. It means you'll pay less each month. But the important thing to say is that obviously interest will have longer to mount up. So you will end up paying more, potentially substantially more, depending on the size of your mortgage over the long term. There are some other options. So you could potentially go switch to an interest-only mortgage, but that is quite risky. Wouldn't recommend that unless you really, really need to, because the trap that a lot of people fall into is to go onto an interest-only mortgage and think, oh, great, my repayments have gone down absolutely loads. And then the temptation to stick to that, even when your financial situation potentially improves, is quite high. And then obviously you're stuck at the end of your mortgage, not being able to pay the lender back. And, if you don't have the money, then you're going to have to sell your home. So not necessarily the best idea. And the other option also is to just chat to your lender. If you are struggling, that should always be your first port of call. They might be able to give you a payment holiday or something like that. Depends on circumstances, but they want you to pay your mortgage, and they will. In a lot of circumstances, they might be willing to be slightly lenient if it means that you can kind of keep on track with it. So worth definitely chatting to them and seeing what the options are.
Simon?
I think so. One thing people should be aware of, obviously, if they are struggling, is that when they ask their lender for help, they should ask their lender what kind of impact this would potentially have on their credit rating, or whether there's going to be a marker put on their file, just so that they totally understand the exact position that they're going to be in. But if you are really struggling, then don't end up not getting help just for the sake of not having some form of mark put on your mortgage file. That is, you're cutting off your nose to spite your face there. And I think we are going to see a lot of pressure put on banks and building societies to show what is known as forbearance, i.e. help people out who are struggling. I imagine that might have been one of the things discussed at the meeting between the bank chiefs and the Chancellor. And finally, I think we mustn't also underestimate the possibility that the government decides to meddle in some way here. Governments have a long and illustrious history in this country of meddling in the property market. And when the going gets tough, the tough get meddling. So I wouldn't be surprised if some slightly crazy scheme gets cooked up.
Don't.
And that's not a criticism leveled at Kwasi Kwarteng and Liz Truss, because chancellors and prime ministers past have been experts at this going back quite some years. One thing that I saw floated on slightly geeky financial Twitter was this idea that they might bring back MIRAS, mortgage interest rate at source. I think it stands for relief. I mean, this predates me. Doesn't predate my existence, but it's the thing that they got rid of at the end of the 80s that was kind of slightly responsible for triggering the final flourish of the late 80s, early 90s housing boom, followed by the big crash that followed. And it's basically the ability to offset your mortgage interest against your tax, which is what buy-to-let landlords used to be able to do in full, but they can't anymore. That would be one way of softening the blow. It would cause huge distortions to the market. And I mean, I think getting rid of it was a good move, and it was got rid of for a reason. But don't underestimate the chances of some slightly crackers plan like that coming forward to deal with this. And I think the only problem with some of those plans is, whilst they might help people in the short term, in the long term, they do have a tendency to cause even more problems.
That's it for part one.
Market updates and conversations around the financial world don't have to be boring. The Digest and Invest podcast by eToro is a great way to tune into what's happening in a fun and easily digestible format. Discover the Digest and Invest podcast at etoro.com/academy/podcasts.
Welcome back. Better news for savers. Nationwide Building Society has increased rates across a number of savings accounts, including a new Best Buy 3-year fixed rate deal paying a top 4.75%. So someone stashing 20 grand in this account for 3 years could expect to earn just shy of £3,000 in interest over the 3-year period. It's also launching 3 new fixed rate deals. So, Helen, how does this rate in the wider market? Bearing in mind, I say top rate now, it could change, in the next 5 minutes. Who knows?
Yeah, it's a decent rate. So this is it's a 3-year fixed savings deal paying 4.75%. It's beaten the next best deal by 0.14 percentage points. So it's quite decent. I mean, let's not get too excited because these rates are still way, way below inflation. But it's a bit of a boost for savers, and it's nice to see it coming from a sort of big building society as well, because quite often these real sort of top rates come from the smaller names, that you maybe haven't heard of. So it is nice to see the big banks finally getting involved, having, for the last couple of years paid absolutely pitiful rates on a lot of their accounts. One thing you do need to probably think about is whether you do want to lock your money away for 3 years at the moment. Rates are going up. It's likely they'll go up further. So, there is a case for maybe putting your money in a 1-year account or a sort of well-paying easy access account. There are still, there's quite a few of those around at the minute. So yeah, it depends on your kind of appetite for, switching your savings account around a lot. But it's a good deal. And if you want to just put your money away for 3 years and kind of leave it, it's not a bad option.
It's my favorite crystal ball gazing question that's a little bit pointless, but I like asking it anyway, Simon Lambert. How high will savings rates go? Now, I relate this to perhaps more your knowledge in this space. Is there sort of do I say a limit that, obviously we're seeing savings rates go up as we're seeing the base rate rise. There's some talk of the base rate going up even to 6%. Whether we can handle that, I don't know. But will we likely see savings rates go up in the same kind of vein, or does it sort of reach a bit of a plateau at some stage?
When I were a lad, you could get 10% on your savings.
Good Lord.
I know. I mean, I were a lad. I think that was like my first ever savings account that I had, but you could get 10% on your savings. When I were a slightly bigger lad and I started working at This Is Money, before the financial crisis, you could get 6% on your savings, 5-6%. It was commonplace to get that. So they could go higher still. We're at 4.75 on a 3-year, 4.3 on a 1-year, only 2.5 on an easy access. That I'd like to see that get up higher. I think that could definitely go higher. It all depends.
You go for 3 years when the 1 year is pretty close.
Well, that's what I was going to say, and that's what you need to think about. And that was a good bit of advice by Helen there, is that you got to think about what's the extra that you're earning. And it's very tempting to go for the highest number because it's the highest number. But if you've got £10,000 in the savings account, that's 40 quid a year. Is it worth your 40 quid a year of extra interest to lock in for 3 years rather than 1? Maybe not. There is this idea that you can build a savings ladder. You sort of cascade down. So you put some in a 5, some in a 4, some in a 3, some in a 2, some in a 1. It's always maturing and you just keep shuffling it around. It's a lot of work. It sounds like the kind of thing that I would definitely lose track of. So I think the 1 years look pretty good at the moment. But you do have to move that money, that old money, get it into an easy, and it's not an all or nothing game. That's the thing to remember is, for example, if you've got a pot of cash and you think, well, I need some of it that I can get at very quickly if I need it. But the other bit, I don't really need that in the short term. I reckon the other pot's fine. Split it between an easy access and a fixed rate. So you're getting the better fixed rate on a chunk of it. And then you've got the access to the smaller amount if you need it. But get it out of those accounts. Get it out of those insult accounts, paying you those pitiful amounts of interest. And I say this as someone who's got money in insult accounts, paying me pitiful amounts of interest and knows I should do this. Set some time aside and do it. And this is also where it might be worth considering a savings platform, because then you can manage all of your money in one place. And that is quite handy. And if you go to thisismoney.co.uk/save, you will find our savings tables with all the best rates. If you're still thinking about your mortgage, go to thisismoney.co.uk/mortgages, where you will find the link to our mortgage finder, and you can plug in the details to see how much it would cost you to fix your mortgage now. And forewarned is forearmed, as they say. So even if your mortgage isn't up for renewal, just understand how much it is. But I think it is a time for people to be thinking about their savings, to be thinking about their mortgage. And one thing that people are also going to be thinking about is it worth me investing? Because if you can get 4.3% risk-free on your savings for 1 year, are you going to put your money in the stock market instead? All of a sudden, we're seeing a bit of a change around because it has been, there is no alternative. So people have been investing, but there is now an alternative. Now, you might get a better return than that from the stock market in 1 year, because you could get dividend return plus some capital growth, but share prices could fall, dividends could be cut. That cash savings is going to start looking a lot more attractive to a lot more people now.
From savings to tax now, overshadowing your tax cuts for all, with a bigger tax cut for the rich is a somewhat, as you point out, Simon Lambert, unorthodox move from a Chancellor, causing a little bit more than a little turbulence, I suggest. So Kwasi Kwarteng and Liz Truss abolished the abolition of the 45p tax rate. But there are some middle-class tax cuts that you can make that can be a vote winner, says our Simon Lambert. So Simon, this week, what's got the cogs of your mind turning?
Well, firstly, whether he abolished the abolition this week or last week was what I was thinking as he was saying that. My head is completely spinning after the insanity of the past month, and I'm finding it very difficult to keep track of when stuff happened. I mean, including to the point where our news editor Mike said yesterday, was the mini budget last week or was it the week before?
It doesn't matter because it changes so quickly. So even if you can't remember when it was, it doesn't matter because there'll be something new next week.
Exactly. Right. So 45p tax. We'll knock that one on the head very quickly. It's staying around. It's not being got rid of. I didn't really have a problem with him getting rid of it. Okay. It really doesn't make a huge difference to the public finances. And by the time you get to paying 45p tax, you've already paid a lot of tax. By the time you're earning 150 grand, you have paid about £50,000 in tax. If someone on 250 grand obviously sees a big benefit from this, but even on a 40p tax rate, they're still handing over about £90,000 in income tax every year. That's a lot of money. But doing this while keeping some other bits of the tax code that are very unfair and, in my description, unhinged, was not the right thing to do. So there's two things there that I think he should do. Firstly, he should stop the removal of the personal allowance above £100,000. That effectively creates a 60% tax rate. So what happens is for every £1 someone earns over £100,000, they have 50p of their personal allowance removed. So that effectively doubles their marginal rate of tax. That effectively adds 50% to their marginal rate of tax. So instead of paying 40% of the next pound earned, they pay 60%. This was brought in during the financial crisis by Labour Chancellor Alistair Darling. But from George Osborne onwards, successive Tory chancellors have turned a blind eye to a manifestly unfair scenario where there are people, albeit on very high incomes, paying higher rates of tax than the people who are on even higher incomes than them. You don't construct a tax system like that. The threshold has never moved. If the threshold had moved in line with inflation, it would currently be £142,000. There's another one of these weird things further down the scale, which is the removal of child benefit. That happens as one parent's earnings rise between £50,000 and £60,000, at which point child benefit is removed entirely. Yet, this is the bit I described as unhinged. Two parents could each earn £49,000, a total household income of £98,000, and they get to keep it all. Totally mad. We have George Osborne to thank for that one, introduced in 2013. It creates a marginal tax rate of 51% for someone who has one child and is affected by this, and 59% if they have two children. If that threshold had risen with inflation, it would now be £62,500. You've got a couple of options here. Either get rid of it altogether or spread the band across which it is removed, which lowers the marginal tax rate and eases the effect of it, or lift that threshold up. Then we move on to another one, and this is one that is for everyone: raising tax thresholds. Fiscal drag doesn't sound like much fun. It isn't. It's a drag. Keeping tax thresholds frozen while wages rise means you pull more people into it. The Institute for Fiscal Studies did a report on this week, and it said by 2025 to 26, These freezes take away £2 for every £1 given to households through the headline personal tax cuts. So there you go, giving with one hand and then taking more away with the other. Among the stats was that freezing the personal allowance creates an extra 1.4 million taxpayers, and freezing the 40p threshold means an extra 1.6 million people paying higher rate tax, pulling 7.7 million into that band, the most ever. The Chancellor should stop this. We should start raising thresholds in line with wages or inflation. Maybe we could even come up with some kind of system where it went up by the higher of those two figures. We could call it the double lock or something like that, maybe. I don't know. It's like maybe an idea. And in fact, actually, interestingly, in the comments on my article, there's quite a lot of people saying that they should raise the threshold at which you pay tax to as high as £25,000. I mean, that would be a massive rise. They're never going to do that. The other things which come on to tax breaks that I think would do some good, insulating and energy efficiency. It became abundantly clear last spring that not only were we going to have a problem with energy price rises at that point, but we were going to have a much, much bigger one this autumn and winter. What the government should have done at that point, to my mind, is it should have doubled down on getting people to insulate their homes and make them more energy efficient. It didn't. It didn't really do much at all. Then we end up with a scenario where we're staring right at the crash approaching us, and we start freaking out and working out what we're going to do. And one of the things we're gnashing our teeth over is the fact that by capping energy prices, as we have done, we are subsidizing middle class, relatively wealthy people's energy bills. It would have been better to get those people to insulate their homes, because then you wouldn't have to subsidize them as much, because their homes would be more energy efficient. But the thing about energy efficiency and insulation is people don't really know much about it. It's quite expensive and it takes you a long time to earn the money back. So give people a tax break. The money that they spend on insulating energy efficiency, they can claim it back against their income tax. It's an extra incentive. It cuts the payback period. And I said in my column, Middle Britain has never fallen in love with insulating its homes, but it loves a good deal. Okay, a chunky tax break would definitely do the trick on this. You'd have people down the pub, on the golf course, in the shops, on their social media, saying to their friends, oh, guess what? I did this insulation on my home. It's a great deal because I set it off against my income tax. I'm going to pay less tax this year, and I'm not going to have to pay as much to heat my home. You should do it. Remember solar panels? That was how that worked when the deal was really good. And finally, self-employed pensions tax credit. One of the problems we have in this country is self-employed people don't save enough into their pensions. Auto-enrollment has solved this problem to an extent for employees, but self-employed people aren't auto-enrolled. The puzzle is, what do you do about this? Because you can't pull the lever of employer contributions in the same way as you can for an employee. So why not offer the self-employed a tax credit that gives them an extra incentive to save on top of the standard pensions tax relief everyone gets? So on your annual tax return, you say how much you've contributed to a pension if you're self-employed, and you get maybe a 10% tax credit on this, i.e. if someone's paid £4,000 into a pension, they get a £400 tax credit. Gives them an extra incentive to do it, and if they don't pay money into a pension, they're missing out on free money. I tested this idea on my wife, who's self-employed, and she said, yeah, that'll probably make me pay more in. Georgie, I'm testing on you. You're self-employed. Would you like a tax credit for paying money into your pension?
Yeah, go on then.
Okay, great.
All right, thanks.
It's a winner.
Yeah, I'm sorry, I'm still reeling from that amazing bit of acting you did earlier. I honestly, it's the next government campaign. I can see it, saving money on insulation. That was brilliant, Simon. You've missed your calling, my friend. Right, finally.
Actually, before we go, I should say that I got some lovely comments from people on my article.
Okay. Yeah. We're not going yet. We've got another story, Simon. But okay.
Yeah, but including one from someone who said to me, Mr. Lambert, we all know your brain is very small. Cutting taxes when the country is 2.7 trillion in debt is not a good idea. There you go.
That's
we
nice.
all know that my brain is very small.
But at least they're reading, despite your small brain.
Yeah, I know. Well, my wife's comment was, well, you do have quite a small head, so it's probably true.
Trust me, Simon, I've got the head the size of a planet. There is no correlation between big heads and big brains. on that note, finally, you do have very interesting readers, as you just pointed out there. This is Money, but some with very interesting kind of backstory. So I haven't read a reader letter in I don't know, maybe one podcast, two podcasts, I'm not sure. But here goes. I have letters and other handwritten items written to me in the 1960s by a world famous rock musician who died young, but has still a following. Judging by online auction prices, I would think they're probably worth 15 to 20 grand. Of course, I paid nothing for them. But if I did sell them, would I have to pay capital gains tax? Oh, Helen, the tease. Who is the world famous rock star? And what were the letters about? Were they like love letters? I mean, surely that would make a difference to how much you can pay for them and stuff. I don't know.
I am so keen to know more about this. You're right. This is a giant tease.
Simon's got a look on his face like he's got an idea. Yeah, I think so. I think Simon thinks he knows. What was the speculation, Helen? Do we know?
Well, we've kind of, there's a few names that we kind of thought, around in the 1960s, died young. I mean, they're kind of, we probably shouldn't say, but, anyone who's into their music would probably have a few ideas about who it might be.
I've absolutely no idea, but I'm not really that into my music, especially not from the 1960s. But anyway, it's an interesting question nonetheless. Capital gains tax.
Yeah, I mean, traditionally, you think about capital gains tax when you're selling, shares or a home, second home. But it is also due on the sale of personal possessions, which are referred to in legal terms as chattels. So the definition of a chattel is something you can touch and move, which doesn't really say much, but letters are included in that. So tax might be due on them. And one thing that Heather, our tax expert, did point out that I think this reader might not have thought of is that these letters, they're kind of intellectual property, right? Because although this reader owns the physical letters, the contents actually belong to the author. And although they've died, that is passed to that's passed to their estate. So be something that kind
even
of
if the letters are written to you, it still originally belongs to the person that wrote it.
Yeah, apparently
that makes no sense to me with my small brain. Simon, what about your small brain?
It's a creative work, isn't it? So it's it's their kind of copyright. Is copyright the right word? I'm not sure, but but once that's sorted out, if she does if she is able to sell the letters, she probably will have to pay tax on them. So you do have a capital gains tax allowance, which is £12,300 each year. And beyond that, you do need to report it to HMRC. Beyond that, you do need to report it to HMRC if the proceeds are more than £6,000. So it depends on how much she sells them for. But if she's if she's getting a fair whack for these, it might well be that she's going to have to pay tax on them.
Simon Lambert, interesting story.
Seems very unfair, doesn't it, having to pay tax on some letters?
I just can't get over the fact that it's not hers. Like the I suppose intellectual property belongs to someone. I mean, all right, if they've laid out some groundbreaking new invention, but if you're just writing between people, then those letters belong to the estate and not to you.
Yeah, well, the problem is also, I mean, this is something that would almost certainly not crop up in normal terms, but although the author has died, the copyright hasn't. So they still have the copyright, and that passes to their heirs and beneficiaries. And if they were a world famous rock star, they are probably likely to have a powerful estate, and the powerful estate might potentially go after someone or take an interest. Or actually, you might find that so much of this stuff goes on that they wouldn't take any interest whatsoever. I think it would depend what was in there. So, for example, say world famous rock star writes you a letter telling you about their day, what they've been up to, not a lot, that kind of thing. Probably not going to be interested. World famous rock star writes you some form of love letter, maybe a bit more interested, but probably not that interested. World famous rock star writes you love letter and writes you a song in there that nobody's ever seen before, the lyrics of,
Fair
and
play.
they never recorded, they're going to take a really big interest in that one, aren't they? So, that's think about it in those terms. I mean, who is it though? We don't know. We actually don't know. So this is a real question, but we really don't know, which is a real shame. But it could be, to give you some ideas. So bear in mind, it says letters were written in the 60s. World famous rock star died young. Doesn't say the rock star died in the 60s. Okay. So that's the important thing to bear in mind.
No, but it's going to be in and around that time, though.
Yeah. So maybe they died in the 70s.
Unless it was letters they wrote when they were like 6 years old or something to their primary school teacher.
Yeah, exactly. The late 60s and 70s weren't a great time for a number of rock stars.
No.
It could be one idea, Mark Bolan of T-Rex fame.
Yeah.
Brian Jones, former Rolling Stone.
Right.
Jim Morrison.
Okay. Yeah.
Could be him, couldn't it? Jimi Hendrix.
Maybe.
Which one would you want a letter from out of those four?
Yeah, Jim Morrison. Yeah, Helen's agreeing with me there.
Yeah. Okay.
Yeah. Don't know why. Just think he could write a good letter.
He does sound like he'd write a good letter.
Right.
Yeah, he probably would write a good letter.
What a great
You're
answer,
right,
Helen.
You're absolutely right. I don't know. I'd like a letter from Brian Jones, I think.
Okay. Did you write back to the reader?
Rolling Stones.
And say,
I was going to say, did you write back to the rock star? It's like, no, they can't read it anymore.
I was going to say there's no point in that. But did you write back and say, look, if you do sell it, we'll do a follow-up kind of article so we know who it is. Can we find out?
Note to self, write back to reader and say, if you do sell them, let us know. We'll do an article.
Exactly. Do that. Right, that's it for this week. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions for the team or anything you'd like them to look into, Simon Lambert.
You can email us at editor@thisismoney.co.uk. And if you become world famous in years to come, we might sell your email. So just to be warned. You can tweet us at thisismoney, or you can come to thisismoney.co.uk/podcasts and join in the debate and read the comments and find all podcasts past.
And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.